Coming back to UTI Factor Allocation Model, which is feeding into UTI Quant Fund. So we discuss how factors tend to do well in different market environment. So in next section, we will discuss the broad approach followed by UTI Quant Fund, wherein we are combining all these four factors dynamically based on our in-house proprietary financial model, which we call UTI Factor Allocation Model. So let me throw some light on the approach that we follow in UTI Quant Fund related to multi-factor approach. So first and foremost, we found that among all these four factors, outcome consistency is much more stronger for momentum. And that's the reason why momentum is core part of our portfolio, while other three factors tend to have higher volatility as compared to broader market. So that's the reason why we are capping their weight at 70%. So allocation towards momentum could be as high as 100%, but we are capping other factors at 70% so that we have a diversified portfolio across different style factors. So when we studied performance of different factors like quality, value, momentum, and low vol, we found that generally they follow 3 to 4 years cycle. So every 3 year plus minus 1 year, style tend to rotate from quality to value and value to quality. So from 2006 to 8, value style has done better. In next 3 years, quality has done better. In next cycle, value has done better. So let me give you some gist on past 2-3 cycles, just to understand how markets have behaved in last few years. So pre-pandemic, from May 17 to October 20, quality style has significantly outperformed value as well as broader market. It has delivered 50% return as compared to 43% fall in value style. Post-pandemic, we have seen very strong macroeconomic recovery. And generally, as I mentioned earlier, generally during macroeconomic recovery as well as very strong equity market cycles, value tend to do better because starting valuations are cheaper, and generally these cyclical companies tend to generate a higher profit growth during good times. So that's the reason why they perform well during very strong recovery phase. So from October 20 to June 2024 phase, value style has delivered exceptionally high 450 odd% return as compared to 100 odd% for quality. In last 12 to 18 months, we are seeing trend reversal in favor of quality, although these are early trend, and in the sense quantum of alpha of quality versus value is not that high, but we are seeing style shift in favor of quality. There are a couple of reasons behind it. First and foremost, government of India as well as state government have a lot of thrust on consumption recovery in recent times. We have seen income tax rebate in the last income tax budget. At the same time, we have seen GST cut, which is providing indirect taxation benefit to the customers. At the same time, RBI is providing a lot of liquidity in the system. So all these measures could drive consumption recovery in next 2 to 3 years perspective, and which is typically most of the quality companies are more consumption oriented. So we believe that both from macroeconomic perspective as well as from equity market cycles perspective, quality style could do well. So that's the reason why quality is having higher allocation in our portfolio. Same is the case for momentum and low vol. So effectively, we are using mean reversion among all these four factors. We looked at previous slide wherein we found that between quality and value style keep rotating every 3 years plus minus 1 year. So rather than chasing a style which has already performed well for last 3-4 years, we build a model which is a mean reversion kind of model, wherein we found we constructed relative performance of quality and value. And as and when quality has done well and it reaches value inflection zone, we start proactively shifting allocation towards value. And when value style has already played out and model is signaling allocation towards quality, proactively we shift allocation towards quality style. So just to highlight last couple of years cycle. So this was 2017 to 20 phase when quality style was doing better. So once quality performs well for certain period and to certain quantum, the allocation starts shifting away from quality to value. On the contrary, when in the previous cycle post-pandemic, value style has played out. So gradually allocation is moving from value to quality in this particular strategy. So rather than chasing a style which has already performed well for last 3-4 years, we use counter-cyclical process, and wherein based on mean reversion, we allocate higher allocation towards style which has gone through difficult phase in 3-4 year period. Same is the case for momentum and low volatility. While first decision tree looks at quality value trend, and while second decision tree looks at momentum and low vol indicator. So between momentum and low vol also, we look at relative performance of momentum vis-a-vis low vol. And if momentum has done well for exceedingly very well as compared to low vol in recent past, then allocation shifts towards value, low vol. And if low vol has performed better as compared to momentum, then model will signal allocation towards momentum. So here also we do mean reversion between momentum and low vol style. This is how allocation across different style factors have changed as per our backtesting results for UTI Quant Fund. So idea for this particular strategy is to identify cycles which could play out over medium to long term perspective. So that's why you are seeing that typically allocation don't change that frequently. So from 2019 to 22 period, when value style was playing out very well, allocation was higher towards value style. But in last 18 odd months, allocation has shifted back to quality. In fact, last 2 years, model is signaling higher allocation towards quality. And we have seen in last 1.5 years, quality has marginally outperformed versus value. So these are early trend in favor of quality. Current allocation is 70% towards quality, 20% towards momentum, and remaining 10 odd percent towards low volatility in our quant fund. So our backtested outcome suggests that rather than following trend, if we allocate money across different style factors based on long-term behavior of these factors, then outcome could be even better than individual factors. So in the previous section, we have seen that individual style factors have performed much better as compared to broader market. So along with those single style factor, which we have already discussed in the previous section, we have added factor allocation model, which we are effectively using in UTI Quant Fund. Here, outcome is even better as compared to single style factor. At the same time, volatility is somewhere between all these four factors. So in the sense, aim is to deliver much better consistent outcome from returns as well as from risk-adjusted returns perspective. So rather than chasing a style which is performing well based on longer term cycles of all these four factors, we keep rotating allocation across different styles based on our in-house proprietary financial model, wherein aim is to deliver much better risk-adjusted returns. Generally, it's extremely difficult to identify when styles are likely to rotate. So if you ask me whether model can pick a particular time when style could rotate, answer is no, because the length and breadth of cycles could be very different from each other. Some cycles could be shorter, some cycle could be elongated, but typically it plays out over 3 to 5 year perspective. So when we studied 3 year rolling performance of our backtested outcome, we found that the probability of generating alpha on 3 and 5 year rolling basis is somewhere between 94 and 98%, which is effectively aim of any quantitative strategy, that on a full cycle basis, it should have higher probability of generating alpha. So based on that particular philosophy, we have launched this particular strategy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.